Today, we will cover the so-called short year rules for corporate tax returns under the Federal Internal Revenue Code. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the law firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees, together with a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my practice of law. Our firm website is www.cummings.law. The concept of a so-called short year in corporate tax returns is a nuanced topic that often perplexes many business owners and financial managers. A short year refers to a tax year that is less than 12 full months in duration. This situation can arise due to a variety of circumstances, such as the formation or dissolution of a corporation or a change in the corporation's accounting period. Understanding the intricacies of a short year is crucial for accurate tax reporting and compliance. Many business owners mistakenly assume that filing a short year return is a straightforward process. It is not. The reality is that it involves complex calculations and strict adherence to specific IRS regulations. The implications of failing to correctly file a short year return can be significant, potentially resulting in penalties and interest charges. Therefore, it is strongly advisable to seek the expertise of an experienced tax attorney and CPA to navigate these complexities effectively. There are several scenarios that may lead to a corporation having a short tax year. One common reason is the incorporation of a new corporation. When a corporation is formed in the middle of a calendar year, its initial tax year will necessarily be shorter than 12 months. Similarly, when a corporation dissolves or otherwise ceases operations, its final tax year will also be considered a short year, again, being less than 12 full months. Another situation that can result in a short year is a change in the corporation's accounting period or accounting treatment. Corporations may decide to switch from a calendar year to a fiscal year or vice versa to better align with their financial reporting and their operational needs. This change necessitates the filing of a short year return to bridge the gap, so to speak, between the old and new accounting periods. Calculating taxable income for a short year is not as straightforward as prorating annual figures. If only it was. Unfortunately, it's not. The IRS requires corporations to annualize their income, deductions, and credits to determine the net tax liability for the short year. This involves complex calculations that must take into account the specific number of days in the short year and the corporation's overall financial performance. Corporations must also consider any special tax provisions or elections that may apply to their specific circumstances. For instance, certain tax credits or deductions may have different eligibility criteria or limitations for short year returns. These nuances underscore the importance of meticulous record keeping and thorough analysis when preparing a short year tax return. Filing requirements and deadlines for short year returns can be particularly challenging to navigate. The due date for a short year tax return is generally the 15th day of the third month following the end of the short tax year. However, this deadline may vary depending on the corporation's specific situation and any applicable extensions. It is critical for corporations to strictly and consistently adhere to these deadlines to avoid significant penalties and interest charges. Late filing or late payment can result in significant financial consequences, further complicating the corporation's tax situation. Engaging with a knowledgeable tax attorney and CPA can help ensure compliance with all filing requirements and deadlines, thereby minimizing the risk of costly errors. One common misconception about short year returns is that they are simply a truncated version of a regular tax return. That is not true. In reality, the IRS has specific rules and guidelines that must be strenuously followed, which can significantly complicate the filing process. For example, corporations must carefully allocate income and expenses to the appropriate tax periods, which may require detailed analysis and adjustments. Another misconception is that short year returns are only relevant for new or dissolving businesses. However, any corporation that changes its accounting period or accounting treatment may also be subject to short year filing requirements. This highlights the importance of understanding the specific circumstances that trigger a short year return and the associated tax implications. Given the complexity and potential pitfalls associated with short year returns, professional guidance is indispensable. An experienced tax attorney and CPA can provide critical insights and support throughout the process, from determining the appropriate tax year to calculating the tax liability. They can also assist with identifying any special tax provisions or elections that may further benefit the corporation. Moreover, professional guidance can help ensure compliance with all IRS regulations and filing requirements, further reducing the risk of errors and penalties. By leveraging the expertise of a seasoned professional, corporations can navigate the intricacies of short year tax returns with confidence and peace of mind. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, L-A-W, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.